Hello and welcome to week 3. Week 3 in accounting is where many students tend to start fading away. It's a little bit tougher material for sure, and they cover quite a bit in this one chapter or this one area that we're going to be looking at. We're going to mainly be looking at 2 new things, and then the third thing is something you've already have done, we've practiced with. But the 2 new things are adjusting entries and closing entries. And the third thing is the financial statements. We've already looked at those in a little bit of detail during week 1, and we'll look at that briefly again here in week 3, but mainly we're going to look at the adjusting entries and the closing entries. So let's go in here. In the resources again, I have these actual lecture notes for you if you want to print them off or have them up while we're going through it. It may be helpful, or you can just watch what we have. And then I have the 2 examples that we're going to go through to make sure everything makes sense. And then finally, like we have the first couple of weeks, we'll end the session with an overview of the My Accounting Lab homework. Okay, the first thing to talk about is the difference between tax and GAAP accounting. The GAAP uses accrual accounting, which says as soon as something happens in your business, like you did a job or you got a service provided to you, you need to record that. So if you did a job, that's revenue, and if a service was provided for you or to you, that is an expense. And accrual accounting says we need to record it as soon as it happens, regardless of cash, if cash was paid or not. With tax accounting, which uses mainly cash accounting says you only record the transaction when cash is actually paid. Thus, if you did a job at the end of December but you weren't paid yet, you don't record it. In accounting, in GAAP rules, you would record that. So what I've done here, and I made 5 or 4 different examples in a way. Normal versus adjusting entries. The normal entries are what we did last week. Things that typically involve cash, things that involve tangible items that we can touch. Those are all very common normal journal entries. Adjusting entries are the ones that do not involve cash, and we have to remember to go back and do them. So what I've done for when I teach this in class is kind of made this into a little table to help us see the 4 different categories or areas of adjusting entries, where they can fall into. We can have a deferred expense, deferred revenue, accrued expense, or an accrued revenue. And here's the definitions. The deferral says you're going to either get your money now or you're going to pay money now. Regardless, cash is taking place up front. And then however, your cash is being exchanged up front, but no work has been done. Either way, you haven't received work or you haven't been allotted work to you. When the work is finally done later on, that's when we're going to go into the adjusting entries at some point later. So we're going to pay now, and that's going to be our normal entry, or we're going to receive money. That's our normal entry. The adjusting entry is when the work is done later. Just the opposite is the accruals. The work is done now. Either we provided a service or somebody provided us a service, and then we're going to have to pay them or receive money later. So when the work is done now, that's going to be our adjusting entry up front, because no cash was paid, so we wouldn't, in the tax world or in cash accounting, we wouldn't have journalized it. So the adjusting entry comes first. The regular entry comes last when the cash is finally paid or received. So here are some typical accounts that are used in each of these areas. So a deferred expense. Remember, the work is done, the money is paid up front, but the actual usage of it or getting it done is later. So if you pay for something ahead of time, this is going to be a new account that we're going to begin looking at, and they're called prepaid expenses. If we remember back to week 2, we talked a little bit about revenue and expenses, and there was 2 things about revenue that have to happen. The service has to be done, and the service has to have been paid for or promised to be paid. Same with expenses. Expenses, you've had to have received the service, and then typically that service is only going to last you less than a year. And it's going to be a rather small dollar amount, nothing like $10,000. That probably wouldn't be an expense, but something under $1,000 probably could be an expense. So the two things with expenses, you're using it right now or within the year, you're going to have used up that item, whatever it is. It could be rent, could be advertising, it could be supplies. And the second criteria is with the expenses, let's see, you're using it now, it's a small dollar amount typically, and you actually have received the service. It's not something that's going to come down the road. That's where prepaid expenses come into play. If you pay for something ahead of time, which some companies require you to do that, a prime example is insurance. You have to pay for insurance a lot of times 6 months in advance. Therefore, you're not getting that use of that insurance. Say you paid it in December and it's good from January through July or through June. You need to record it on your books because you made a payment in December, but you didn't actually get the use for that expense until the following year. So we're not going to expense it in the year that we paid it in December, because that would not, our books, that doesn't reconcile with what really happened. We're going to expense it when it actually, we got the benefit of it. Same thing with this new terminology, depreciation. Depreciation occurs when you buy a long-term asset, items like a vehicle, if you bought a building, if you bought some land, any type of big equipment, things that are going to last you more than 1 year, and generally things of pretty high value that's going to make a difference in your company. Well, those items, we count those as assets, long-term assets, but those items eventually will wear out and we won't use them anymore. So instead of keeping a vehicle on our books, say what we bought it for at $15,000, eventually we want that vehicle's worth to slowly go away because we're slowly using that vehicle. Now, how much we actually take away from the value of the vehicle has no determination on what it's really worth in the real world. Those two we do not combine those two. What's going on in the real world is completely arbitrary. We don't know. It could be subjective. But what we're going to do is very rational and say, if we bought something for $15,000 and are going to use it for 10 years, then I know every year 1,500 of that item's value is going to be used by the company. And then after that 10th year, the vehicle should be pretty much worn out. We're going to get rid of it, and it's not really worth anything left in our books because we've used it. We've used it completely for what it was meant for. Another new item here is unearned revenue. Unearned revenue basically is, since one of the items in the regular revenue wasn't met, meaning the job wasn't done, somebody had paid us ahead of time to do work, and then we won't get to it until the next reporting period. So we can't call that revenue if we haven't actually done the work. And we open up a unearned revenue as a liability account. Remember, liabilities are if you owe somebody something, not just money. And in this case, we actually owe them a service. These other two we're more familiar with: accounts payable, accounts receivable, and then items that are similar. Wages payable just means that we owe our workers money, just like accounts payable is we owe another store money. Interest receivable, I think that's pretty explanatory. We have made somebody a loan and then they owe us interest along with the principal amount. I wanted to go through a couple of the examples just to kind of show how these work with the adjusting entries. So a deferred expense, so up here in the first quadrant of my little graph, a deferred expense, and this is question 1A, because there's two of them if I remember, the expenses, the prepaid expenses and the depreciation. So let's look at the prepaid first. So in this example, in November, we prepaid for $1,000 in rent, $500 going for the current November month, $500 to December. So the normal journal entry, what we already would be used to, would say, all right, I've received the benefit because this is the current month of November. I received the benefit of $500 of rent, and I am going to receive a prepaid rent expense. I'm going to receive rent in a following month. Notice I can't expense the full $1,000 because I'm not using all $1,000 right now. And then showing a credit to cash because I have spent my cash. And then come the December 31, we now have used December's rent, and I must remember nothing really happened. Nobody paid more money. Nobody came and told me that the rent is now used up. I just have to remember to go in and say, this prepaid rent that I originally had put down, remember that's going to be an asset. Any prepaid accounts are assets. I now need to get rid of that prepaid with a credit and debit the rent expense. If it helps you to visualize this, I highly recommend going back to week 2 and printing off some T account sheets and practicing these and using the T account sheets to help you keep track of what's debited, what's credited. In that prepaid rent has a debit balance right now, so I need to go through and credit the prepaid account to get rid of it. At the end of December, I have no more prepaid, and all of it needs to be expensed. Let's go down to the depreciation. On January 1 of the current year, I purchased $10,000 worth of equipment, and we'll say it was with cash. It doesn't matter how we bought it, but we'll just say it was with cash. And the useful life is 5 years. So on the January 1, when cash was involved, that's my normal entry. What did I get? The question, what did I get? I got a piece of equipment. How did I get it? I got it through giving out money, spending money. So I debited my equipment and credited the cash for $10,000. Now, after the first year, I have used some of that equipment. And if it's only going to last me 5 years, after 5 years, I need to have expensed all $10,000. Notice I did not expense any of it in the very first day. I put it as an asset because I own it and it's something long term. Now, eventually, I start using it. And when we use something, and I have the wrong numbers here, this should be 2,000. I'll try to remember to update your notes so when you get it, it will say 2,000. So after a year, and if it only has a 5-year life, 2,000 of its value I have theoretically used. So what we do is this new account called depreciation expense. I do not call it equipment expense, depreciation expense. And then this other new account, which I'll kind of show you what it looks like on a Excel sheet when we open up the next assignment. The accumulated depreciation is what's called a contra account. Contra means it's backwards. Its plus minus is actually flipped from what its normal parent category is. Accumulated depreciation goes right next to the equipment when you're looking at a trial balance in the order. So if equipment, say, has an account number of 150, the accumulated depreciation will have an account number of 151. We want to group them together because I want to know how much depreciation have I totaled year after year for that piece of equipment. So for the first year, I've only had the 1 year. But when we get to the second year, I'm doing another $2,000. If I was to look at my balance in the accumulated depreciation, its balance would be $4,000. That's one of the reasons it's called accumulated. So it's going to accumulate every year of depreciation that I've had. So 2,000 plus another 2,000 gives me a final balance of 4. The expenses are different, and we're going to see that at the second part of this lecture When we talk about closing entries, revenues and expenses, if you remember back to week 1 when we looked at the accounting equation, and I said revenue and expenses will eventually go away, they get closed. And so every year we start over. You don't ever hear of an accountant or some business saying, we had $30,000 in revenue, oh, and by the way, that included 3 years worth. Generally, when you talk about a revenue or expense, you talk about it from a year-to-year basis. And so those numbers, you can't just get rid of them. We do have to put them somewhere, and you'll see we put them into retained earnings, an account in owner's equity. Deferred revenues, which one of the most common items we're going to use is unearned revenue. So basically, we got paid ahead of time to do a job that we're not going to be able to complete until at least January of the next year, of the next reporting cycle. Thus, when I do get the money on the 18th, I have to record that. I have to show that my cash went up. However, I cannot show that I have earned the revenue and actually call it revenue. So I have to call it unearned revenue, which is a liability account. Unearned revenues would go in the same as accounts payable, wages payable, but unearned revenue, we still owe somebody something. It's just this time it's a service. Now, come the end of the next month into the next year, we have now done the job. So we no longer owe anybody a service. So we need to get rid of that. We need to credit the liability account, which will zero it out, and then put what we actually did, the service that we performed, into our revenue account for that $400. So the revenue will go into the following year, not the year that it was paid. Now, so we've done those first examples were all deferred items. So money was paid up front or received up front, work done later. The accrued side is just the opposite. Where work is done up front, money is transferred at a later point. So we're going to do the adjusting entries now first for these type of items. So an example, wages payable, accounts payable are some good examples of accrued expenses. And here's one. So December 15th through the 31st, and that's when the employees, they worked through that time, and they're paid $2,500 in January. Maybe they worked a little bit into January too. But however, they've only earned $2,000 as of the end of December. So they worked a little bit in January. That's where that extra $500 comes from. At December 31, even though we haven't paid the employees, we still need to show how much work they've done this year. I need to keep when they have done the work in the current year. I don't want to put all of that money into the next year because they didn't do all that work in the next year. They did most of it this year. So I show that they've done work, and I show that we owe them money with this new liability account called wages payable. Then when January 3rd rolls around, I can then have the normal journal entry and show that, okay, no longer do I owe them any money because I paid them. I paid them not only the $2,000, but I paid them the $2,500. So that means there was an extra $500 of work that was done in the current year. So I'm only expensing $500 in the current year instead of the full $2,500. Because most of the work was done last year. And then the last one is something we're very familiar with just through our just through last week, is when somebody says they'll pay us later. We do a job now, and then we bill them for later. So on December 28th, we completed the job, and they'll pay us later, so we debit our accounts receivable and credit the revenue account. Come January 10th, we debit when we actually get paid. We're going to debit the money, saying, what did I get? I got money. Why did I get the money? Because it came from the person's account. So they no longer owe me anymore on their account receivable. And we have zeroed it out. Okay, let's do maybe just a couple examples, and then you can look at the rest of them from my answers that I've provided. Let's look at Julie's. What you're going to need to do with Julie's is have open the Julie GL only, number 9, and the Julie Review, number 8. And then hold off on the answers until you've actually done it, and then go back and look to see if you've done it right. Okay, I'll pull up the, well, you might have to, I'm going to have you have it up separately because it's too hard for me to go back and forth using this program to know, to be able to make it very effective, I think. So if you're watching this, I hope that you have pulled up the Excel sheet. I'll be referring back to that. I can see it on my screen, but I know you cannot. That's why you need to have the print off. So if you're looking at the Excel sheet with the trial balance pulled up, you've noticed some of the accounts. A couple of them that stick out to me that I know I'm going to need to adjust. The prepaid accounts, the accumulated depreciation, probably have another year of that. The unearned revenue, it's probably no longer unearned, I'm going to guess. And then possibly some of these other items, but we'll see. Let's go to, so I can find a good one. So here, let's just look at the first one. Julie required payment in advance to make a billboard design for Sears. She does not plan on completing the project until at least January of next year. So if I'm not going to do the work, I can't count it as revenue. She received the payment on 31st, $2,500. She'll receive the money this year, but not doing the work until later. And then she recorded the entry as a debit to cash and a credit to sales revenue. Well, that's going to be incorrect. That should not have been, the debit to cash is fine, but we cannot call it a credit to sales revenue. So this is an example of a correcting entry. So we're going to need to go in and undo sort of a way to get this out of there. This may not be the best example to start with, but we'll work with it. Okay, so now what I've done is pulled up the answers just for this first one. I know you can't see it, but hopefully you will pull it up with me. What I've done on this one is I went ahead and debited, if she credited sales revenue, making it look like we had earned revenue, I'm going to get rid of that. I'm going to pretend that never happened. So get rid of that debit to that credit of $2,500 with a debit to $2,500, and then credit what account should have been credited all along, which was the unearned revenue to Sears, not the service revenue or the earned revenue. Now, the next one is more of an adjusting entry, very similar to what we did just a couple minutes ago. So her employees were last paid on the 14th of December. They've worked for 2 weeks. As of the 31st, they have earned $1,500, and then they'll be paid $1,800 come January 2nd. So what we need to do is, even though they weren't paid, we need to show that they were, they did do the work. So that when people do work for you, that's a wage expense. And we're going to expense it for how much they did in that current year, not including any holiday pay or the next, whatever happened into the next year. So we're going to debit our wage expense for the $1,500 and then credit our liability account that says we owe money of $1,500. I'm going to skip down. Let's skip down to the Julie finished her project for Bistro. Notice here I don't give an amount. Well, that's okay. You can go back to the original trial balance and you can determine how much money and how much amount of service did Julie need to do for Bistro. So what I've done now is I've brought back up the original trial balance, and it shows us account 210 unearned revenue at $1,000. I owe $1,000 of service to this bistro company. Well, as of now, at the end of the year, I have done that work. So I no longer owe them money. So if I don't owe them, I want to get rid of that credit balance with a debit to $1,000 and then credit the account that shows the work's done, which is revenue. Okay, you can use those examples as you're going through to practice. I will now bring up closing entries. While I'm getting this, I'll go ahead and pause real quickly. Okay, the best way to go about explaining the closing entries is to actually bring up the practice help that I have put into Blackboard, which is a continuation of what we did back in week 1. I'm looking at the Tyler's shop, which is my Tyler example that I have made up. And in this example, I have us prepare the closing entries. We'll briefly talk about the post-closing trial balance, but not a great deal right now. And then the 3 financial statements, which you should have a basis in. Remember, that's the income statement, the statement of retained earnings, and the balance sheet. So what the closing entries do is, if you remember back to the first week, the accounting equation, the bare bones, stops after owner's equity. It's just assets equals liabilities plus owner's equity. The reason is these accounts eventually at the end of the year get closed. So everything down below retained earnings will go to 0 at the end of the year, and that includes your drawing account. Because drawing is very similar to a wage expense. Wage expense means you're paying the employees. Drawing means you're just paying the owner of the business, so you're paying out money. So we also close that one. How I help students remember what we close, and I'll put this out to the side here, hopefully you can see it, are the red accounts. If you want to think of an acronym, RED, your revenues, your expenses, and your drawings or dividends, whatever terminology you want to use. And all of these accounts then get closed into the retained earnings. So you'll notice we already have a retained earnings balance of $11,000. That was from all the prior years that the company has been in business. Obviously, we've done good because we have more money coming in through revenues than we did going out in expenses on a net year-to-year basis. And now hopefully with this year we can just add to that number. So the first thing what I want to do is I want to close out my R account in the red, the revenue. And each of these accounts I'm just going to simply close to my retained earnings. And all we do is just take whatever balance it is and then get rid of it. So if it has a $20,800 balance on the credit side, that means that to get rid of it, I need to debit my revenue account by $20,800. Let me pull this up. And then the account that we close everything to is the retained earnings. And so off to the side here, I've created a little running T account to help us visualize this. So I have $11,000 starting out from what the trial balance told us. And now I just closed the revenue of $20,800 with this entry. And then I have these 4 expenses. I need to get rid of them for the end of the year. I need to make those zeroed. So if they have a debit balance, that means I need to credit them. So over here I've credited all the expenses and then debited it to retained earnings. So I'm taking money away from the business, or earnings if you want to talk about it that way. Of the $20,800, I'm removing some of that due to the expenses I paid out, which is very normal. And then finally, the D account, the drawing, I need to get rid of that as well. If it has a debit balance, which it will, drawing is another contra account. Remember the accumulated depreciation that we talked about a few minutes ago in the adjusting entries? Accumulated depreciation are contra accounts. So they're opposite of what all of the other assets are going to be. All the assets are going to be debits, except your contra accounts, which are your accumulated depreciation. So if I was looking at this from the prior examples that we were looking at with adjusting entries, my equipment, sorry, this should have said equipment number 2 or number 1. My equipment has a value left of only $4,000 on my books. So if it's a 10-year asset, then I can expense it out for 4 more years. If it's a 5-year asset, I only expense it out 2 more years. Hopefully you can see how I'm doing that. This equipment, I've purchased it obviously probably rather new, probably has a 7-year life just by looking at it. By doing the division here, it comes out nicely to 7. And so I've only used just a small bit. So it still has $6,000 book value left, and that's called book value because that's what it is on my books. That is not the same as fair market value. Fair market value is what somebody will actually pay you to buy your piece of equipment. And what it is on the books is no bearing on the fair market value. But as we go back to the closing entries, I'm ready to close out my drawings. And I do that here, credit the drawing because it had a debit balance. Debit the retained earnings. Now when I add up the credit side, subtract out the debit side, I have a final retained earning balance of $13,000. So my retained earnings did go up a little bit, and that's good. I would like to see my retained earnings slowly go up, if possible, every year. What a post-closing trial balance does then is just summarize what you've just done. So if you notice, all of my assets and liabilities, they didn't change any. The big parts that changed were, notice the dividends are gone, the drawings are gone, the revenues are gone, the expenses are gone. They're all summed into this retained earnings category, and everything still balances my final totals. That's how I know I did it right. And then if you wanted to review back onto the income statement and what the balance sheet does, those are here as well, but I'm not going to take the time to go through them.